దూర విద్యా విధానంలో డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ దేశంలోనే మొట్టమొదటి సార్వత్రిక విశ్వవిద్యాలయం. దాదాపు 2.5 దశాబ్దాలుగా దూర విద్యా విధానం ద్వారా కంప్యూటర్ కోర్సును అనుసంధానం చేస్తూ BA, BCom, BSc డిగ్రీ కోర్సులను అందిస్తోంది. పోస్ట్ గ్రాడ్యుయేషన్ స్థాయి, డిగ్రీ, డిప్లొమా స్థాయి కోర్సులను ఔత్సాహికులైన విద్యార్థులకు అందిస్తోంది. డెవలప్మెంట్ స్టడీస్లో సెంటర్ ఫర్ ఎకనామిక్స్ అండ్ సోషల్ స్టడీస్ ద్వారా MPhil, PhDతో పాటు విశ్వవిద్యాలయమే స్వయంగా దూర విద్యా విధాన అంశంపైన PhD వంటి పరిశోధన కోర్సులు ప్రవేశపెట్టింది. సుమారు 4.5 లక్షల మంది విద్యార్థులు ఈ విశ్వవిద్యాలయం నుంచి ఉన్నత విద్యావకాశాలు పొందుతున్నారు. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం స్థానికంగా స్వయం బోధనా పద్ధతిలో ముద్రణ రూపంలో రూపొందించిన కోర్స్ మెటీరియల్ అందిస్తోంది. కోర్స్ మెటీరియల్ అధ్యయనానికి సహకరించే విధంగా రేడియో, టెలివిజన్ పాఠ్యాంశాల ఆధారంగా కార్యక్రమాలు ప్రసారం చేస్తోంది. అధ్యయన కేంద్రాల ద్వారా ఏర్పాటు చేసే సలహా సంసర్గ తరగతులు, సైన్స్ ప్రాక్టికల్ సౌకర్యాలు విద్యార్థులకు స్వయం అధ్యయనానికి ఒక చక్కటి అవకాశం. ఇవి విద్యార్థి సమీపంలో ఉండే అధ్యయన కేంద్రం నుంచే పొందొచ్చు.
Welcome dear students to this teleconference facilitated by Dr. B.R. Ambedkar Open University. The topic for today's discussion is computation of tax liability of individuals. This is for the benefit of the BCom final year students of the university, and it is drawn from the course Income Tax. Income is earned by an individual, and on this income tax has to be levied. The total income earned by an individual is levied the rate of tax applicable for the current assessment year. Now, this discussion is a live discussion, and we would like the students to consult us, and the following are the telephone numbers: 040 2703 1431, 2703 1432, 2703 1433. To facilitate this discussion, we have experts here: Dr. Malla Reddy, Associate Professor, Dr. B.R. Ambedkar Open University, and Dr. Patrick, Assistant Professor, Department of Commerce, Osmania University. To begin the discussion, I would like to ask Dr. Malla Reddy, could you please familiarize the students with the basic concepts?
Income tax is levied on the total income of the previous year of an assessee in assessment year. Tax levied on income is income tax. And when we come to the different concepts, the first one is income. Income is what we earn. When we indulge, when we undertake certain economic activities, in return we derive monetary benefit, and that monetary benefit will result in increase in our wealth in a particular period. In simple, what is earned by us is our income. And in Income Tax Act 1961, the concept of income as such is not defined. Only the items which are included in income are listed in that particular section. It is only a inclusive one, not exhaustive one. And as per that particular section, profits and gains, dividends, any taxable portion of the perquisites, contribution made by the employer to the contributory pension scheme, contribution made by the employer to the recognized provident fund of the employee over and above 12%, and interest credited into the recognized provident fund over and above 9.5%, casual incomes, winnings from horse races, other card games. These are the different incomes which are listed in the Income Tax Act under section 2 subsection 24. And if we look at the characteristics of these items, income must come from outside. For example, if wife receives some amount from his husband, it is not her income, and income may be from temporary source or permanent source. It may be earned legally or illegally also. For that matter, amount income earned through smuggling also is taxable income, and income may be voluntary or as a contractual obligation we may receive the income. So these are the the items which are listed in the Income Tax Act, and the other concepts, assessment year, previous year, and we have seen the term assessee, person. And when we come to the assessment part of it, the income tax is levied or charged in the assessment year. Assessment year is the year, a period of 12 months starting from 1st April and ending with 31st March of next year. During this period, the income earned by the assessee during the preceding year is put to tax, and that preceding year is known as previous year. Previous year is also known as income year. The income which is earned in previous year is charged to tax in the assessment year. And when we come to the term assessee, income tax assessee, assessee is a person. Now, a person may be an individual, person may be a firm, person may be a company, Hindu undivided family, person may be association of persons, body of individuals, and artificial person. So a person, any one of these may be income tax assessee. So income tax assessee is a person who has to pay some amount, who has to pay income tax or some amount to the government. So when the assessee has to pay income tax for himself, he is known as assessee. Sometimes may be assessed to in relation to others' income also, then also he will be regarded as assessee. And assessee also may be classified as assessee in default. When the DD goes, employer, when he deducts tax and when he when he does not remit into the government account, and then he is regarded as assessee in default. And when we get when we have to get some refund from the income tax department, so then also a person is regarded as assessee, and these are the important terms with which the students should be familiar to understand the subject of income tax.
So that was the concepts to start with. So dear students, we have learnt the basic concept of what is an income, what is an assessment year, what is a previous year, and who is an assessee. Depending on these, starting with these basic concepts, now we are ready to go into our topic. So as we already told, the topic is computation of the tax liability. In order to compute the tax liability, we should first know what is the total income. So I'd like to ask Dr. Patrick, could you please tell us what is total income and how it is computed?
Now, according to the Income Tax Act, what we notice is the income is divided into 5 heads. We call it as income from salary, income from house property, income from business and profession, income from capital gains, and income from other sources. Now, before we go about with ascertaining the total income, what we need to do is we need to ascertain the residential status of the individual, because the income tax is levied based on the residential status, and based on the residential status we talk about three categories, that is resident and ordinary resident, resident but not ordinary, and an NRI. And in the case of resident but ordinary resident, what happens is the income that is earned abroad is also treated as income and it is taxable in India. And what we do is we go about with ascertaining the incomes, what I mentioned in these 5 heads. And before that, whatever are the incomes which are excluded for the purpose of income tax, we don't take it under consideration. That is, it could be incomes which are exempted. I mean, if you look at the word income from salary as such, there are a lot of components. We talk about basic, we talk about DA, that is the dearness allowance. There are a lot of other allowances that have been provided, and there are perquisites that have been given. So allowances, when you look at it, is given along with the salary there, and things are looked into as the allowances which are fully exempted, partly exempted, or fully taxable that are there. So the ones which are exempted, like agricultural income or income which is there as dividends from the domestic companies that are there, are not to be considered. And whatever are the provisions that hold good according to the Income Tax Act of 1961, for the 5 heads we go about with working it out there. And then there is a provision that is related with clubbing. Sometimes what happens is individuals tend to deviate, that is, they try to divert their income into somebody else's income there. At times what parents do is they try showing their FDs in the form of their minor children and others. So this part of it is considered and taken into the guardian or the parent's income. And there are certain rules, like, you know, when you look for incomes that are earned under these 5 heads there are rules which need to be carried out, which set off and carry forward. So this is to be followed. And after doing these things there, we go about with adding these 5 heads, and that is where we get the gross total income. And from this gross total income, we deduct what is called as the permissible deductions, which is allowed by the law, which range between the sections 80C to 80U. We look at it a little later. And once this is done, we go about with calculating what is called as the tax rates, which are applicable according to the slab rates. Every year in the finance bill, the tax rates are being worked out, just as what Professor has said about the assessment year. So what would be applicable is mentioned in a finance bill. So the entire administration is being carried out by the Department of Income Tax, which works under the Ministry of Finance or the Central Board of Direct Taxes under the Government of India. And once this tax rates are being applied, and we go about with computing what is called as the tax liability of an individual there. And from that, whatever is the advance tax that has already been paid in the past, or TDS that is there, is being deducted to arrive at the net tax liability of an individual.
Okay, so that was a very beautiful explanation given by Dr. Patrick there. So this computation of total income is a sequential process. So not all incomes are taxable. There are certain incomes which are exempted. So we take only those incomes which are taxable. Now these taxable incomes are divided, or rather they fall under 5 different heads of income. Now each of this head of income, there is a separate method in which you calculate the tax liability. The first major head of income, or the more important head of income, is income under the head salaries. So we will start with the head income from salaries by asking Malla Reddy sir, how do you calculate income from salary?
Yeah, as you said, the first head of income is salaries, and under this head, the salary includes wages, basic pay, your pension, dearness allowance, and whatever amount is contributed by the employer towards a pension scheme, and amount contributed by the employer towards recognized provident fund over and above 12%, and the interest credited to recognized provident fund over and above 9.5%. So these are included in the term salary. And if you divide the computation of salary into different parts, the first part is salary, then allowances, then perquisites, then profits in lieu of salary. When we go to the allowances. The allowances may be fully taxable allowances, partly taxable allowances, and tax-free allowances. For tax-free allowances will not become part and parcel of your income. For example, if it is foreign allowance given to the employees, it is totally tax-free. And there are certain allowances which are fully taxable, like our dearness allowance is fully taxable. City compensatory allowance is fully taxable. If we have given any project allowance, non-practicing allowance, family allowance, all these allowances are fully taxable. So, just they are included to the salary. And when we look at the partly taxable allowances, the important one from the point of view of examinations is house rent allowance. And the house rent allowance is given by the employer to the employee to meet the cost of rent. And this HRA, house rent allowance, it is fully taxable if the assessee or the employee is not paying any rent. If he is staying in his own house, if he has got his own house and if he is not paying any rent, the total amount of HRA is taxable. And if he stays in a rented house, the treatment is, the Act provides 3 conditions. The first one is actual HRA received by the employee. The second one is excess of rent paid over 10% of salary. And the third one is if the the place of work is Bombay, Delhi, Kolkata and Chennai, 50% of salary. Of these 3, whichever is least is deducted from actual HRA received. And the remaining part will be added to salary, taxable portion. And if the place of work is in any other city other than these 4 major cities, it is 40% of salary. And the students must know the concept of salary for this purpose. Salary means basic pay, and it also includes HRA, it also includes DA, dearness allowance, if it becomes part and parcel of the pay for the purpose of calculating retirement benefits. And if any fees is given, any commission is given, any fixed commission and the turnover is given to the employee, that is included in the salary. So, salary for this purpose, basic pay, DA and any commission if it is given to the employee and turnover. So, this is the then if we come to the, there are certain other allowances, particularly only important allowances we will cover here. For children education allowance, if children education allowance is given to the employee at the rate of 100 rupees per child, for 2 children it is allowed. If any hostel allowance is given to the employee, it will be 300 rupees per child, again it is limited to 2 children. And if any conveyance allowance is given, any travelling allowance is given, that these are whatever amount is incurred or spent by the employee, the unspent portion will be the taxable. And one important allowance, transport allowance. Transport allowance is given to the central government employees, and the transport allowance, in the case of transport allowance, 800 is deductible, and deduction exemption is given. In case of physically handicapped employees, it will be 1600. And when we go to the third part is perquisites, salary, allowances and perquisites. And the perquisite is an additional emolument given to the employee. It is attached to the a particular position that employee is occupying in his office, and it may be given in cash or kind. And again, these perquisites are classified into tax-free perquisites and taxable perquisites. And when we take the tax-free perquisites, any medical facility is provided by the employer, it is a tax-free perquisite. And if the employee takes treatment in any outside hospital, private hospital, and up to the amount of 25,000, which is incurred by him, that will be reimbursed to him will be tax free. And if the employer provides any free education to the children of the employee, that is again tax free. And if any cost of what you call refresher courses, any benefit, anything is provided by the employee, that will be tax free. And when we come to the taxable portion of the perquisites, the important perquisite is rent free accommodation. When the rent free accommodation is given to the employee, and for the purpose of calculating taxable portion, we divide the employees into government employees and private employees. And regarding government employees, if the accommodation is owned by the government, that means employer owns the accommodation. Whatever the rent is fixed by the government, that will be the taxable portion. And in case of non-government employees, if the accommodation is owned by the employer, and the places are divided into three categories. One is bigger towns, cities, the cities where the population is more than 25 lakhs. In that case, 15% is the taxable portion of the perquisite, 15% of the salary. And when we come to the middle cities where the population is between 10 lakhs and 25 lakhs, it is 10%, and in other cities, smaller places, it is 7.5%. And this is when the accommodation is owned by the employer. And there may be a situation where the employer takes the accommodation on rent and provides to the employee. In such cases, it is 15% of the salary or actual rent paid by the employer will be the taxable perquisite. And to this rent free accommodation, if furniture is provided, when the furniture is provided, 10% of the cost of furniture will be added to the taxable portion of the perquisite. And if this particular furniture is hired by the employee, whatever hire charges are paid by the employer will be added back to the taxable portion. And when we come to the another important taxable perquisite in case of employees is provision of cars. When motor cars are provided by the employer to the employee, and if the motor car is fully used for office purposes, it is not taxable, it is tax free. And when it is totally used for private purposes, the total amount of what you call amount spent by the employer, whatever the cost he has incurred, will be the totally it is taxable. And when the this motor car is used both for office purposes and private purposes, and a car is divided into two classes like big car and small car. In case of a big car, when it is when it exceeds the capacity of car exceeds 1.6 liters cc, it will be 2400 rupees per month is taxable perquisite. And in case of small car, when the capacity is less than 1.6 liters cc, it will be 1800. And when the chopper is provided, when the driver is also provided, the driver's salary at the rate of rupees 900 will be added back to the taxable perquisite. So this is the very important. These are the important perquisites from the point of view of students, from the examination point of view particularly.
Okay, thank you very much, sir. So now I think the students would have a fair idea of what is salary. So as sir was saying, salary is divided or subdivided into 4 different subheads. The first subhead is called salary, second subhead is called allowances, third perquisites, and fourth profits in lieu of salary. Under the subhead salary, you have got basic pay, bonus, commission, and excess of employer's contribution to recognized provident fund over 12% of salary, interest credited to provident fund over 9.5% of the rate. Allowances are categorized into 3: fully taxable, fully tax free, and partly taxable. Fully taxable allowances are DNS allowance, city compensatory allowance, lunch allowance, family allowance, etc. And sir had explained to you all about partly taxable, and the most important of the partly taxable allowance is house rent allowance, where the exemption is least of the following: actual rent paid minus 10% of salary, or 50% of salary where the employees live in metropolitan cities, 40% of salary if they live in other cities. And here salary is basic pay plus dearness allowance if it enters for retirement benefit, and commission if it is paid as a percentage of turnover achieved by the employee.
And Rabindranath, here,
Sir.
as you said, when we add these four
Subheads.
components,
Yeah,
we get gross salary.
gross salary.
And from gross salary, there are two deductions again. Deductions, as Patrick sir said, every head will have its own deductions. And under section 16, deductions are allowed from
Salary.
head salary.
Gross salary.
Yeah, gross salary. The important one is entertainment allowance, which is given only to the government employees. If it is up to 5,000 and what you call 1/5 of salary, whichever is less will be deducted. That is one entertainment allowance. The second one is professional tax,
Okay.
tax on what you call employment. So after deducting these two items, we get net income. That net income will be the income chargeable to tax under the head
Salary.
salary. That is the
Okay,
taxable salary.
So, the four subheads are called gross salary, and from gross salary you give deductions under section 16, which is entertainment allowance and professional tax paid. So, sir, that was the explanation with regard to salary. And the second head of income after salary is house property. Patrick sir,
Yeah.
could you please tell us about house property?
Now, income from house property is charged on the rental revenue which the assessee or the taxpayer gets. And this is something different from the other heads of income because this is notional income. It may be on the value that is received or the capacity to earn the income out of a house property that the assessee is made to pay the tax. The student needs to be acquainted with certain terms which come under this assessing of the income for the house property there, or income from house property as we call it. Now there is something called as annual rental value. In this, what it means is the capacity to earn income out of the house property. Then there is what is called as the municipal value. Now the municipal authorities go about with having a host of factors with which they base the municipal taxes and other things there. So they go about with telling what could be the rental value of that property. And if the same property with all those features that are there in that area, what amount of rent it could earn. Now this is where we call it as a fair rental property. If the house property is controlled under the Rent Control Act, this is usually done to ensure that the owner goes about with getting a fair rent and the tenant has not been overcharged or forced to evict and other things there. We talk about what is called as the standard rent. The other thing is the rent receivable or rent received out of the house property. Now once we are acquainted with this terminology, we talk about what is called as the GAV, that is a gross annual value. Now this is computed two ways there. One is if we go about with taking the highest of these three things, that is the fair rental value, the municipal rental value, or the rent received. If the house property is controlled under the Rent Control Act, then we talk about the standard rent or the rent receivable, whichever is highest. So once we have got an idea about what this GAV is, from this if we deduct what is called as the municipal taxes and the other expenses that are related with it, we get what is called as NAV, that is a net annual value. From this net annual value, there are two deductions that are there under section 24. And one, first we got to make it very clear that if an assessee has got two house properties there, one is taken as self-occupied and other is taken as let out. It is the choice of the assessee as to which one would he like to claim it as self-occupied, which one does he go about it claiming it as let out there. If there is an element of tax planning, he can reduce the tax liability by claiming the one which is bigger, which is let out. He can claim that as the self-occupied, and he can change over the years which he wishes to claim as self-occupied and which he wishes to claim as let out. And from this, under section 24, what we do is under NAV, the first deduction that is done is 30%. A standard deduction is done from that NAV towards repairs and other expenses that are there. And in case of a let out house, whatever is the money that is borrowed and the interest that is being paid on it is taken for deduction. So after deducting these two deductions that are there, one is the 30% and the interest part of it there, the remaining amount what is left over is called as the income from house property. And the student has to know that if you differentiate the income from house property from all other properties, what you notice is it's called as the notional income, because at times it could look like the person is trying to value the house in which he is occupied, and he goes about it claiming that is let out. So here we talk about the notional value rather than the actual income that is received or receivable.
Okay. So that was about income from house property. So as sir was saying, income from house property is taxable on notional basis, it is not the actual rent that is taxable, but it is the annual value that is taxable. And in computing this annual value, there are three factors which are very important. One is the municipal rental value, then the fair rental value, and the actual rental value. Now, if the house is covered under the Rent Control Act, you also have another element called the standard rental value. So, a comparison of all these three, whichever is highest would become the gross annual value. From the gross annual value, deductions under section 24 are given, and these deductions are for rent 24A and 24B. 24A is for interest on loan taken to purchase or construct the house. 24B and 24A is for standard deduction, which is 30% of the net annual value. So, 24A is 30% of NAV, 24B is interest on loan taken to purchase or construct the house. So, from the gross annual value, when you give municipal taxes as deduction, you get the net annual value. On the net annual value, you have 24A, which is 30% of the net annual value, and 24B, which is interest on loan taken to purchase or construct the house. When you do all this, what you get is called income from house property. So, we have covered income from salary explained by Malla Reddy sir, and income from house property explained by Patrick sir. Now, we will go to the other heads of income which are important from the exam point of view, and I would like to ask Professor Malla Reddy the other heads of income, please.
Yeah, the other heads are income from business, income from business or profession, capital gains, and the last one is income from other sources. So, when we come to the income from business or profession, the income earned by doing business is taxed as business income, and from the student's point of view, we get the net profit disclosed by the profit and loss account, and that is taken as a source of income for the purpose of computing the income from business, and to which certain expenses already claimed will be added back. For example, there may be some personal expenses which are debited to the P&L account, and they are not allowed as per the provisions of the Income Tax Act. And for example, depreciation charged on in residential accommodation, and these things are already debited to the P&L account, and as per the provisions of the Income Tax Act, they are not allowed. So, they have to be added back. And to the profit and loss account, on the credit side, there may be some items shown as incomes, like income from house property, income from sale of land, let me say. If something is shown as on the credit side of the P&L account, that really does not relate to the business. So, that is the reason why what we do is, we will deduct from the net profit. So, like that we arrive at the income from business, which is calculated as per the provisions of the Income Tax Act. So, that is that will be the income from business. And under the same head, the income earned by the professionals like doctors, chartered accountants, advocates, artists, and whatever income they also earn by doing their profession, that is also charged under this particular head. And where what we do is, we take the whatever the total of professional fees they have collected, and from which we deduct the whatever expenses they have incurred in relation to their profession, and we get the income. So, that will be charged to tax, or that will be the taxable income under the head income from business or profession. And the fourth head, when we go to the capital gains, and the capital gains is the fourth head, and where during the previous year when the assessee transfers a capital asset by selling it maybe, then if you get any profit on that, that is regarded as capital gains. For example, the capital gains may be long term capital gains and short term capital gains. If the long term capital asset is held by the assessee for more than 36 months, and after holding it, after owning it, let me say, if he sells and transfers the property, whatever profit gain he gets on that is known as capital gain. And in case of long term capital gains, what we do is, the cost of acquisition, the cost of renovation if he has done anything, These things are what you call indexed and in view of the inflation factor, and that will be compared with the sale price, and the difference will be the profit to the assessee. And in case of short term capital gains, if the asset is held by the assessee capital asset for less than 36 months, that is a short term capital asset. And in case of shares and which are subject to the securities transaction tax, the period for treating them as short term capital gain is only 12 months.
Okay.
And why we classify is the long term capital gains are taxed separately at separate rate, and short term capital gains are charged to tax at separate rate. Long term capital gains are taxed at the rate of 20%, and short term capital gains at the rate of 10% if that is subject, that capital asset is subject to the transfer of capital asset is subject to the security transaction tax. And when we come to the last head is income from other sources, that is the residuary head. And whatever income that is earned by the assessee, if you are not in a position to fit that income into the 4 heads so far what we have discussed, that will be included in the income from other sources. And in the income from other sources, what incomes we include will be importantly dividend. The investor who gets dividends that is taxed in the income from other sources, and importantly the salaries of the MLAs, MPs will be put to tax under the head income from other sources, not under the head salaries. In the same manner, if any machinery, plant and machinery is let out by the assessee, the rent, the rental income on that. If any plant and machinery which is let out along with the building, let me say, if these two are not inseparable, then that will be taxed under the head income from other sources. And some other casual incomes also, like winnings from lotteries, crossword puzzles, and card games, race horses, and whatever income that you get from these things also will be taxed under the income from other sources. For example, I will give you if any payment an employee receives from a person other than his own employer, that will be taxed here. For example, if you see a university teacher, let me say working with Usmania University, if he gets anything from Usmania University, maybe examination, remuneration, whatever remuneration, that will be put to tax under the head salaries. But if he receives any remuneration from, let me say, from Dr. B.R. Ambedkar Open University as an examiner, as an expert, then that is not put to tax under the head salaries, but that is put to tax under the head income from other sources. And like that, some interest earned on bank deposits, interest on securities, all these are taxed under the head income from other sources. So when we add up all the incomes, as we have seen, we compute the income separately under each head, and the resultant figure under each head will be what you call totaled, and the total amount will be let me say gross total income. Before that, there will be certain adjustments to be made to that income. So this is about the remaining 3 heads of income computation part.
So Dr. Patrick, Malla Reddy sir was saying that when you club all these heads of income, it is called the gross total income, and then he also happened to mention that you have to make some adjustments to this. So what are the deductions, or what are the adjustments, or do you have any provisions for clubbing or things like that?
Yeah, like what sir has very nicely said about the other 3 heads that were there, apart from salary and house property that we have discussed there. He summarized it very beautifully. We have certain provisions, like to divert attentions of the tax authorities. At times what the assessees do is they divert their sources of income to some minor or to their relatives to see that their tax liability goes about with coming down. So in this case, the tax authorities ensure that these incomes are being clubbed with the taxpayer, or let's say fixed deposit is made in the name of a minor. So minor is not liable to pay the tax. In this case, either of the parents whose tax income is higher, it is clubbed with them and he's made responsible. But if a minor is able to earn on his or her own capacity, let us say due to some creative activity like singing, dancing, or winning some competition, in that case there's no clubbing which is done. And once this clubbing is done, what we go about doing is we talk about not every time we make profit or positive incomes are generated out of the 5 heads that are there. So in this case, we talk about set off and carry forward. So in this case, what we go about looking at is we have to do what is called as an intra head adjustment first and then talk about inter head. What do I mean by this word intra head is, let us say it is to do with business and profession part of it. A person has got more than one business. So when I'm trying to adjust a loss of one business to a profit of another business, I'm calling an intra head kind of an adjustment. Okay. But when I go about with making an adjustment of loss of one head, that is income from house property, I try adjusting with income from salary, then I call it as an inter head kind of an adjustment. And there are certain norms which are being given by the income tax authorities which is to be followed. Let us say that it is to do with an intra-head kind of an adjustment. What we notice is if there is speculative kind of income that is there, it can't be adjusted against any other head. If there is a short-term capital loss that is there, you can adjust it against long-term capital. But the thing is, long-term capital loss cannot be adjusted against any other head. Okay. And the other thing that we notice is if there is any income that is earned of owning and maintaining HOTS related businesses, in this case, this particular loss cannot be adjusted against any other head. And there are other provisions which we talk about when it comes with setting off with the intra-head. And when it comes to the inter-head, income or loss that is there from house property can be adjusted with salary, but the losses that are derived out of business cannot be adjusted against salary part of it. And how many years can we go about with carrying this thing there? Like, the loss that is incurred in any of these heads is carried over to the next year where the adjustment is made against that particular head. And if it has still not been recovered, we can carry it forward for many more years. There is a restriction that is being put. Let us say if it is to do with income from business or profession, you can carry forward the losses for 8 assessment years in future. If it is to do with the losses that are there with owning of a HOTS or maintaining it there, and the income that is generated is negative or you get a loss, you can carry it forward for 4 years. And the income that is there, the losses that are there from capital gains can be carried on for 8 years. So we need to go about with following the norms that are being listed out in the Income Tax Act, and then we go about with computing what is called as the gross total income.
Okay. So dear students, just to summarize what Dr. Patrick was telling us is that first you have to compute income under each of the heads. Income under the head salary has been explained to you, income under the head house property, and income under the head business or profession, capital gains. And if any income is there which does not specifically fall into any of these other heads of income, as a last resort is taxable under a residuary head called income from other sources. So total of all this is called as the gross total income, and from the gross total income there are certain adjustments which have to be made. These adjustments are called as set off and carry forward of losses. For example, if there is a loss from one head of income, that loss can be set off, that is deducted from the incomes available under other heads of income, for which the Income Tax Act has certain rules and regulations which have to be followed. By following those rules and regulations, we have to set off the losses, and then you have to aggregate the incomes, that is you have to add, you have to club the incomes of other individuals into the income of the assessee, and for that also there are certain rules and regulations which have to be followed. Dr. Patrick has told us all those rules and regulations. Now we have come to the stage where we know how to calculate the gross total income of the assessee. From the gross total income, as Dr. Malla Reddy was telling us, there are certain deductions which have to be given. Now we will ask, sir, what are the deductions from the gross total income?
The people should understand that tax is not levied on gross total income. From gross total income, certain deductions are allowed by the Act, and we call these deductions as deduction under chapter 6, deduction under chapter 6, and these deductions are given to encourage the what you call the people to save, and also to contribute to the pension scheme, and to pay as a premium on their health insurance, and even generously when people give donations, even for that also deductions are various deductions are given under the section 80. from 80C to 80U, different deductions are allowed to the individuals. And when we come to the important deduction with which most of the employees are what you call concerned is deduction under section 80C. Deduction under section 80C is given to the employee for the savings he makes.
Yeah.
For example, whatever amount he pays as LIC premium, if he contributes to the what do you call that pension scheme, and if he contributes to general provident fund, statutory provident fund, public provident fund, all these savings, they qualify for deduction under section 80C. And these savings will qualify for deduction up to rupees 1,50,000. 1,50,000. And the important one is LIC premium, and even GLIC, government employees will pay GLIC, that is deducted here. And under section 80CCC, when the employee what you call contributes to the pension fund, maybe pension fund of LIC or other insurance companies, and that is also allowed as deduction under this particular section up to a maximum of rupees 1 lakh.
Okay.
1 lakh. Then the important deduction is 80CCD, which relates to the contribution made by the employee towards the pension scheme, contributory pension scheme, that we call national pension scheme.
Okay. NPS.
NPS. Here, whatever the amount contributed by the employee during the previous year from his salary is allowed as deduction up to the 10% of his salary.
Okay.
Salary here, as we all know, basic pay and what do you call that DA, if it enters into retirement benefits. And this is allowed under section 80CCD. And there is a restriction on the total amount of deduction allowed under section 80C, 80CCC and 80CCD, that is rupees 1,50,000. Maximum amount allowed, aggregate of the deduction allowed under the three sections is 1,50,000. And one more under section 80CCD 1B, in order to encourage the what you call the employees, there is an additional deduction of rupees 50,000 is allowed. 50,000 is allowed to the employees who contribute to the pension scheme. For example, let me say, as an employee, you might have what you call paid LIC premium under public provident fund. You might have paid already 1,50,000. The total amount is exhausted there.
Yeah.
So, in order to encourage such employees, additional benefit of rupees 50,000 is given, which can be claimed under section 80CCD 1B. And whatever since it is a contributory pension scheme, employee contributes and also employer contributes, and the amount contributed by the employer is also given as deduction. And this deduction is over and above the 1,50,000 rupees which is allowed under section 80CCE, and this deduction is allowed up to the what you call up to the 10% of the salary of the employee which is contributed by the employer will be allowed. Okay. This is under section 80CC D. And another important the one is medical premium paid by the employee. Most of the employees nowadays, we are contributing to the health schemes, health insurance. So that is called Mediclaim. Mediclaim policy. Whatever amount is paid by the assessee for himself, for his spouse, for his children is allowed as deduction under section 80D. 80D up to rupees 15,000. Up to 15,000. If assessee himself is a senior citizen means who attains the age of 60 years during the previous year is a senior citizen, and in case if he is a senior citizen, amount allowed is 20,000. And again here under the same section, in order to encourage the what you call people or employees to take insurance policy on their parents also, additional deduction is given. And when the employee takes medical insurance policy and pays premium on that, an additional amount of rupees 15,000 is given as deduction under this section. Okay. And if parent is a senior citizen, it is 20,000 is allowed. So if the assessee himself is a senior citizen and parents are also senior citizens, maximum amount of rupees 40,000, 20 plus 20, 40 can be claimed by the employee as deduction under section 80D. These are the important deductions under section 80C, 80CCD and 80 what do you call
D.
80D. And one more deduction I will cover here, that is section 80E. When the employees take education loans, education loan may be for himself or for his children, because most of the children nowadays are going to the abroad to pursue higher education there. And most of us, what we do, we take loans from financial institutions or banks, and whatever the interest is paid by the assessee here, employee assessee, on the educational loan, total education loan paid by the employee during the previous year is deducted under section 80E. There is no limit on this income, on this deduction.
Okay.
Total interest paid by him will be deducted. So, these are the important deductions, which are allowed to the individual assessees.
So that was a deduction under section 80C explained by Malla Reddy sir. Now we will ask Dr. Patrick, are there any other deductions which are important from the exam point of view? There might be many deductions, but limit ourselves to the discussion from the exam point of view on deductions under section 80.
Thank you. As rightly pointed out by Solomon sir, what I notice is there are a lot of deductions which are given from 80C to 80U, and it gives a list of deductions for all the assessees there. As he has rightly pointed out, as a student, even you need to go about it focusing on the deductions which are relevant with the individual, because here we are talking about the tax liability associated with an individual there. So there is an exhaustive list, and you got to look at what applies for an HUF, what applies for a corporate assessee, what applies for an AOP, BOP are different from what applies for an individual. Now, just now we had Malla Reddy sir covering the deductions that are relevant with an individual, starting from 80C to 80D and other things that are there. Now, I would focus on a few deductions that are there, and one of them is an exhaustive deduction which looks very huge in terms of bulk, that is 80G, because it's got a lot of issues that are there. Now, this is to do with the deduction that you make for donations that have been given. Right. The government goes about with encouraging people to make monetary donations to various charitable organizations, religious outfits, or to various other organizations that are there. Now, under this, what we notice is you got to go about with classifying the donations that are there comes under 4 different categories for understanding from a student perspective from the exam point of view. First is we look at donations which are 100% deductible without any limit. Now, under this, we have the contributions made towards the National Defense Fund, or for the National Illness Fund that is there to reduction, whatever research is done that. And the second thing is 100% deduction with limits. And here we talk about the contribution made towards any authorities, institutions, or organizations which are local bodies that are there, which promote family planning, sports, and other things there. The third category is 50% deduction without any qualifying amount, and this is for PM Relief Fund, or it could be Rajiv Gandhi Foundation and other things that are there. And the fourth category is where we talk about the 50% deduction, which comes with the qualifying amount. Now, every time we're talking about the qualifying amount, it's similar to what Professor Malla Reddy sir has just referred. It is the 10% of the gross total income that is there. So there is a huge list, if you run into the items, if you look at any of the tax books, the 30-40 items, and which needs to be segregated by the students into these 4 if you have to claim the deduction under donations there. Then we look at GGA is another, that is section 80GG is one of the sections that is there. As sir has referred a little while ago talking about HRA. In the salary component, if the employer doesn't go about with paying what is called as the HRA, then in that case 25% of the salary, or 2,000 per month, can be claimed as a deduction by an individual. Okay. And apart from it, there is section QQB, which refers to if an individual is able to earn money in the form of royalty for the books that he has published, and this doesn't include textbooks or journals or diaries, any other books which advances scientific development and other things, to a tune of 3 lakhs, there's a deduction permitted. There's another thing which is to do with the 80 RRB, and here the royalty that is earned on patents and other things to a tune of 3 lakhs is allowed as a deduction. And there is a section called 80 TT, which is to do with whatever fixed deposits and other things an individual has, to a tune of 10,000 he can claim a deduction. And under section 80U, which is the last section that is there, if a person is suffering with a normal disability which is certified by a physician, to a tune of 75,000, they can go about with claiming an exemption, or in case that a person goes about with having what is called as a severe disability to a tune of 1,50,000 can be claimed as a deduction.
Yeah. So, dear students, at this point in time, I'd like you to remember that this is an interactive session and we would want the phone lines coming, and we have got a caller right now. Hello. Hello.
Hello.
Yeah, tell me.
Good afternoon, sir.
Good afternoon.
I have a question regarding the deferred tax liability and deferred tax asset. What is the difference between deferred tax liability and deferred tax asset?
Yeah. Madam, thank you so much for asking this question, but this teleconference is with regard to computation of tax liability of an individual. If we go into aspects of deferred tax liability and all, we wouldn't be able to cover for the benefit of the students the rates of tax, because the very important point of this discussion is the rates of tax. So, Malla Reddy garu, please tell us the rates of tax very quickly, because our entire discussion is focused on the tax liability.
Right? Yeah, the income of the individuals is put to tax in a slab system, and the total income is divided into what you call 4 slabs, and from up to 2,50,000 is one slab, first slab, that is nil tax. If no one tax. Gets total income up to 2,50,000, he did not pay any tax. From 2,50,000 to 5 lakhs, on this 2.5 lakhs income, income tax is charged at 10%, that comes to 25,000. And from income ranging between 5 lakhs and 10 lakhs, the rate of tax is 20%, and over and above 10 lakhs, the rate of tax is 30%. And after computing the tax like this, what we have to do is, to small employees, one rebate is given. Under section 87A, a rebate is given to the extent of rupees 20,000. So, 20,000 is deducted from the tax calculated by that, and on that educational cess of rupees, education cess of 2%, and 1% for higher education, these things. Total 3% cess is what you call charged on that. Then we will be arriving at the tax liability of the individual. And here 2 important things we have to remember. The total income is rounded off to nearest 10 rupees, and the tax liability is rounded off to nearest 1 rupee.
Okay.
This is the important
So, dear students, the very important aspect here, the rates of tax for the current assessment here. The first 2,50,000 goes tax free, it is exempted from tax. The next slab is from 2,50,000 up till 5 lakhs, the rate of tax is 10%. From 5 lakhs to 10 lakhs, the rate of tax is 20%, and income above 10 lakhs, the rate of tax is 30%. So, these were the rates of tax. So, this was the discussion on computation of tax liability of an individual. I thank the experts Dr. Malla Reddy and Dr. Patrick for coming here and discussing this topic with us. Thank you.
Thank you very much. Thanks for the viewers.